Let's talk about extremes. The extreme stable store of value. This is safest that you can find. And a massive, out of control debt. Believe it or not, they are very closely related. Let's explore. You want to talk about extreme. Well, the vision on your screen right now is of some gold coins that were actually used for transactions. Gold coins. Not very often, but these $20 gold double eagles were indeed money and circulated as such back in the day. Of course, nowadays we see the gold eagles that we can buy as bullion coins to stack and to hold as wealth preservation devices. And these particular coins are also minted by the United States government, and we hold them and buy them in order to protect ourselves, because gold is long considered to be a store of value and a hedge against economic uncertainty. What does that mean? You've heard me say that time and time again, but that means that gold can protect you from inflation as well as deflationary periods, and there's anything in between in any kind of economic uncertainty. And that is all buoyed by the debt, which is coming down and weighing like a ton of bricks. Well, I'm going to be sharing with you an infographic from Visual Capitalist that makes that correlation here between gold price and the U.S. debt over the past 53 years. Just looking at this, the visualization of this, I think, is quite intriguing to see, and it's so great that they put this together as they correlate the gold price from the debt here. And gold is often seen as that store of value. As a result, when concerns about the U.S. debt and economic stability arise, investors tend to flock to gold, driving up its price. And we can see here, looking at the top of this, we're going to go from the top and work our way back, because that's where the height of this thing is. Before the debt ceiling talks began, we were poised to stop at $31.4 trillion. But if you look at the usdebtclock.org, it obviously was much higher than that. It got to 31.7. Well, now we've averted a, quote, disaster. But look at where gold is now. Pretty much right in line with this debt ceiling, and now we're starting to see it, kind of fluctuate and flail around here during this period, and in a period of volatility that happens at these peak highs, like what we saw back in 2011 or 2012. During that time, high fluctuation at the peaks, and we see here this jagged edge is continuing. Now, is this a potential or a foretaste of what's to come? In other words, will we see it just fall again, all but crash down to these levels here that we're seeing with a new floor, a new support for gold? That very well could be probably in this area here. If you see my mouse, it could possibly dip to there and create yet another new floor. What will that be? Is it going to be $1,800 an ounce, $1,700 an ounce? Who knows? But one thing we know for sure, which will not go down, and that is the debt. And we see through here that through this period of time, it's gone on and followed fairly closely with that debt. In 2021, U.S. public debt surged as the government allocated over $5 trillion to fiscal stimulus and relief packages in response to the COVID-19 pandemic, which brought the biggest jump in that debt, and gold's price just followed right along there. And in August of 2020 is when we saw that big high there. So there you go. Let's go back down a little bit. You can see the correlation and how they follow each other. Maybe not exactly, but close enough. Close enough for sure. But when we go back to the year 2000, we can see that the total public debt has risen annually, except in the year 2000 when it was decreased by 2% due to factors like a robust growth and the budget surplus. That was a little bit of a one time where it kind of went down a little bit, but it didn't take long before it to go back up again. And we know what happened to gold during that period of time, it overreacted and shot down in the other direction. And that's about the time when it was trading, at around $300 an ounce. And boy, that didn't last long. I remember those days thinking, wow, this seems crazy. Is it going to keep continuing to fall because it had been up so high, much higher in years gone past? And then we see it as the debt grew, so did the price of gold grow as well. One thing is for sure, this is one way we know whenever the debt increases and government spending increases, that is going to bring about inflation. And even if they get it back to 2%, we know that the debt is going to flow upwards, and deficit spending is going to continue, and likely the debt to GDP is going to continue to be in the triple digits, and that doesn't fare well. That coupled along with the de-dollarization fears that we're starting to see, that are starting to put cracks in the dollar's hegemony upon the whole system, that is going to just bolster the case for gold. Not only that, but there's real fear and legitimate fear about what the central banks are going to be doing around the world in terms of digital currencies. We're moving in that direction, central bank digital currencies. Literally days from the moment that I'm recording this video, the U.S. Fed Now service will be in effect. That means all transactions will be flowing through the Federal Reserve and will be vetted through that system. Now, it's not set up with any kind of DEI or ESG now, but when they implemented a central bank digital currency, those factors will come into play. No question, no doubt. Mark my words, it will be coming. It's all about control, and they are tightening the grip, and they're setting in the infrastructure for that with the Fed Now service. Nonetheless, we go back in time when the debt did increase at a steady rate since 1980, and even really beforehand, it just starting to pick up the pace in the 80s, especially when we started the arms race with the Soviet Union during that time. Gold had rocketed up in epic proportions as part of the Hunt brothers and other factors that came into play there. And then it pretty much stayed up and fluctuated and kind of went independent of the debt, really up and high in price compared to the debt. It really wasn't until we started to see the debt start to flow back up again at around 2005 and 2006 that we saw a really strong correlation between the debt and the price of gold. And I think this is an example of seeing gold starting to really come into its own in terms of its value. And I think this is what we're seeing, and we're going to continue to see that play out, especially with the latest pieces of legislation that are going to force the Federal Reserve's hand. They're going to have to print more money in order to meet the services that are required. They're going to try to get more from the taxpayer with the IRS agents and the like, and audits, increased audits. But that's really not going to do it. They can tax us 100%, the entire population. I don't think they'll have enough to meet the demands in order to get the deficit spending under control. So they're going to have to print more money, which is going to put more pressure and are going to give us another hidden tax with increased inflation. So there is another bullish case, I think, for gold. And what does it mean to be bullish on gold? I think what it means is essentially that gold is just going to do what it has done for thousands of years. It's going to maintain its value. And so when we think about this debt, it's the amount of money that the federal government has borrowed to cover the outstanding balance of expenses incurred over time. And every fiscal year, if spending exceeds the revenue, the federal government borrows money by selling marketable securities such as treasury bonds, which is why the treasury bonds are also so important. The bond yields, for instance, in terms of gold and silver's price from day to day. These bills, notes, floating rate notes, the treasury inflation protected securities, which are known as TIPS, those are done in order to cover the deficit spending. The American public debt has risen annually since 1970, except in 2000 for a very brief amount of time, as we mentioned, due to factors like robust growth and a budget surplus. Over the last few decades, the national debt has grown from around $370 million in 1970 to an all-time high of $31.4 trillion in 2023. And that has sparked a debate about the debt ceiling. The number is even higher if considering federal unfunded liabilities. No one really talks about that. This is going to blow your mind, folks. Those are future financial obligations that the government has committed to but lacks the sufficient funds to fully cover, such as Social Security, Medicare. Taking those into consideration, the current present value of the fiscal imbalance is $244.8 trillion, almost 10 times the current U.S. Gross domestic product. Almost 10 times. Can you imagine $244 trillion? Now, you think about it, I have shown on this channel a note. It is a note from Zimbabwe from November of 2008. Is the $100 trillion bill. I used to joke and say we could pay our national debt 3 times over with this note. But now we may need 3 of those notes in order to really take care of everything. It's insane. It's insanity. And what is this? These are the unfunded liabilities. But then we also have, not necessarily related to the debt, but in terms of the system in general, which is around these liabilities, these derivatives, as it were. These derivatives, which are just nothing in space, that represents exposure to the price of commodities, the futures markets, and the like. That's where the manipulation is, folks. You've got the manipulation by the Fed, and you've got manipulation by the markets in general of all of these derivatives, which provide exposure with nothing backing them up. To me, it's really criminal, the kind of activity and the kind of system that we have set up here, and it all needs to be changed. But one thing is for sure: you can't derivatize gold in the physical form. They do it in the commodities markets, and there's no question about that. But when you hold an ounce of gold in your hand or an ounce of silver, you know you have something of value that you can't just go and just grab out of the ground. It's got to be mined, and it's got to be, it takes time and energy and money to do it. So there you have it. So I hope this provides some insight, a little bit of an interesting visualization, and I hope it encourages you that you are indeed doing the right thing by holding on to gold. So let me know what your thoughts are in the comment section down below. Would like to extend a multitude of gratitude to each and every one of you for taking the time to watch this video, and to encourage you to please rate, share, comment, and subscribe.